Well, good morning or good afternoon, depending on where you're logging in from. Welcome to our market update. It is officially 9 a.m. on West Coast time. Because there's a lot of people joining today, we're going to wait about, let's say, 2 or 3 minutes until the scroll starts slowing down here. Super excited for today's webinar and our market update with our expert, Bill Bodnar, but we're going to give it a couple minutes here and get going. Okay, once again, it's 9 a.m. We appreciate everybody showing up this morning. We're going to give it a couple minutes as we're waiting for everybody to join in. We had over 300 registered for today's call, and I know it's scrolling in fast. So thank you for showing up. We're still climbing. Okay, it's 9:01. I'll give it probably one more minute here in the sake of making sure we get everybody on the call. Thank you all. We appreciate it. In respect of time, we will get started here in a minute. Come on, let's see some smiling faces this morning. It's a beautiful day. Hovar's dancing in the background. He's got a beautiful lake with some beautiful trees. Okay. Out of respect to time, I know everybody's busy. I'm going to go ahead and launch our call. Well, welcome to our market update. And we appreciate so much you pausing your business, your lives to show up today. My name is Robert Lipston. I run production for Evergreen Home Loans. We're super excited for today's market update. If you're not aware, Evergreen Home Loans is been in business since 1987. We're based in Bellevue, Washington. We are Fannie Mae, Freddie Mac, Ginnie Mae direct seller servicer. We are someone that retains a lot of our business and has about 34,000 clients that we service today. We offer a full range of mortgage products, both delivered to the secondary market and our own innovative portfolio type products. Our founder, if you're not aware, Don Burton, actually was a past real estate broker in the Seattle marketplace. And when he couldn't find the innovation and the partnerships he could in the marketplace, he started Evergreen in 1987. And since that day, our entire goal has been adding value to our business referral partners, family, and friends from the real estate space. So today, our entire goal was to add value, and our mission is to arm you with content to deploy when engaging with your clients. With that said, I know for a fact that if you turn on the TV, log into social media, listen to the radio, anything you turn to today, there is an enormous amount of noise, volatility, and information being shared about the world we all live in every day and make dreams happen and solve for the dream of home ownership. So what we wanted to do today was bring to you a subject matter expert, somebody that lives in this space every day. So I'd like to welcome to our call the Chief Revenue Officer, Bill Bodnar from Tabrasa / the Mortgage Market Update or Mortgage Market Guide / MMG. Bill has been in the business and has been with the company over 24 years. Bill is a partner in this business and spends every day using tools, analytics, and brings great, relevant, timely information to our industry. We're super excited to welcome Bill to the call, bring you some great information. With that said, I'm going to give you a quick disclaimer. Today is about sharing information, financial information, and economic data, once again, to help you communicate with your clients. Thank you all for coming and welcome, Bill.
Robert, thank you for having me. Thank you, everybody. I'm going to share my screen here. And it's great to see you all. Yeah. And by the way, 9 o'clock in the morning, it's great. I started early here in New Jersey, 6 a.m. local. So I've been at it. So I feel like I'm going back in time. So this is fantastic. You can see my screen. Terrific. So, yeah, this is not going to be your typical economic talk. And to Robert's point, great intro. There's a lot of noise out there. So we're going to try to parse through the noise, try to make some of this stuff relatable. My role day in and day out for the last 25 years is to help thousands of folks in the mortgage space, as well as on the real estate side, just kind of navigate what's happening because there's no shortage of information. So we're going to talk in real time. We're going to take some questions at the end. And so let's go ahead and jump into it because I do have more than 30 minutes worth of content. And so I'm gonna go kind of quick. So Rob, I'll also get you this article to share with the folks that registered for this call. I collaborated on an article with National Mortgage Professional, this Become an Instant Economist. And it doesn't make a difference if you're a loan officer or you're on a real estate side. We have to know a lot of these things, what to watch, what do they mean? Because as you shared, the media can sometimes, omit things, twist things, and you got to kind of look at the data. So we're going to talk a lot about that as we go through this. So I'm a big golfer, and the theme is the back nine and kind of where things are in the back half of the year as we
Hey,
approach.
Bill,
Yes, sir.
do you have the ability on your side to turn up your speaker a little bit
Turn it up or
or
turn
your
it.
microphone? Because you're a little bit light for the audience.
Okay. How
I
about
know Bill is logging in from his vacation with his family on the beach to do this call today.
well, is that a little better? I can speak
It
a
is
little.
a little better.
I'll speak a little
Thank you.
slower and a little louder. So
Perfect. Thank you, sir.
you bet. So the front nine, now to talk about where we are, before we talk about where things are headed, let's talk about where we are, like where the first half of the front nine kind of ended. And so again, inflation, it was a big problem for years, still kind of a problem, but it's much less of a problem. It's at a 4-year low, right? Unemployment. We have to remember we sell homes and we're trying to buy, provide mortgages. Well, we need people employed, gainfully employed. 4.1% is a very tight unemployment rate. That's like full employment. That's a good story. Jobs buy homes. The BBB is passed. Again, we're going to stay out of the politics of it. It's a big deal. It helps us in the housing. That's going to be the punchline. We're going to talk through it because it's providing clarity. There still remains tariff uncertainty. And at the end of the day, folks like Evergreen and all around the country, to the other Robs that I speak to, we're doing deals. And it just shows how resilient mortgage and housing is despite all the uncertainty that we've gone through over the last 6 months. So probably the biggest thing that I'm thinking about, when I'm talking and doing these state MBAs and stuff, like what's a big nugget to take away? This is a big one. Clarity. And listen, we haven't solved everything, but having fiscal policy now in place through this big, beautiful bill changes a lot because it doesn't make a difference where things go, taxes and regulations. If I'm a CFO, if I'm a business leader, an entrepreneur, I'm a consumer, you just need to know where things go so I can make a decision. The good news is that just happened, and that's going to be a tailwind for us as it relates to growth. We need growth in the economy, and this is going to be a big deal for us. So these are the things that we're going to talk over the next, call it 25 minutes or so, a bunch of things. And I definitely want to spend some time on rates, but Fed, inflation, GDP, all of this stuff. And these are all things as a mortgage and housing professional, you need to be swimming in because what we're talking about today, what's great about it, whether you're talking to a client or you're talking to your business partner, it's ancient history. Next week, and on July 30th, we're going to tell you to mark that date. It will definitely be ancient history on July 30th. So let's go through this. So the back nine, this is an interesting slide. As I made this was the top 5 bullets were exactly what I said last year. And then the bottom one is the one I added. So Fed rate cuts are coming. Isn't it funny? Here we are literally a year later. We're still talking about the same thing. Fed rate cuts. Inflation is moving lower. The labor market is less tight. That is true. The housing future is bright. People want to buy homes. We see it every single time interest rates come down. There's a flurry of activity. But the progress has been slow and steady. The big change between last year and this year, and why I'm super optimistic, is new fiscal policy. New fiscal policy that is kind of centered around a lot of things, growth and, you know, trying to manage our debt and deficits, which are, really out of control. We're going to talk about that too. But we're still experiencing some pain. I'm going to spend a few minutes with Mr. Powell because it's front and center. I mean, yesterday he was fired, he wasn't fired. We're going to talk about all of it. But we have to remember that mortgage, what he does, he's managing a short-term overnight interest rate, really has no bearing on our world and mortgages, because it's a short-term rate. And we witnessed what happened last September when he cut rates by 0.5% right in the middle of that cycle there in September, which was kind of odd. And then to go that heavy, the bond market didn't like it. So who knows if he's skittish about cutting rates, but he's got some problems. And one thing I could tell you, I want the Fed to have independence and be removed from political. I'm not a fan of this whole thing, firing and all that other crap. It doesn't make sense to me. But at the same time, boy, there's justification for him to cut rates just based solely on the numbers. And we're going to go through that right now. So, a couple of weeks ago, they came out with their every Fed meeting, they hike and cut rates, whatever they make that decision. And every 3 months, they update their summary of economic projections, which are their forecasts on economic activity. And by the way, these things are subject to wild changes. And Fed Chair Powell has admitted, even at his most recent meeting, that they're not really good at forecasting. It's because it's just not easy. It's impossible. There's too many things to input. And so he's saying, in the Fed, that growth is going to be slower than anticipated. Unemployment's going to be a little bit higher, and inflation is going to be markedly higher. Now, remember, as you take this, you say, okay, wow, the Fed said inflation is going to be much higher. Well, it wasn't that long ago where Fed Chair Powell said high inflation was going to be transitory or short-lived, and that was miserably incorrect, right? And then a year later, he said, oh, wait, the disinflation process has begun, and that was miserably incorrect. So, he has said some bad things, and we're going to talk about all that, but he's wrong on interest rates right now for a lot of reasons, on inflation and other fronts, and we're going to work through this. So what we're hearing, and what you may have heard, is this term, hey, we can't fire him. It's probably disruptive to the market, but maybe we can install like a shadow Fed. And that's bubbling up. It's happening like right now as we're talking. And so what does that mean? Well, essentially, it's this idea that instead of the markets listening to what Powell's saying, because even, the dissension is coming even amongst his Fed members, maybe we install somebody or we make an announcement. Hey, Jerome Powell is gone next May. And the good news, we have Kevin Hassett, Kevin Warsh, whatever it looks like. Now, why would they do that? They would do that because it would neuter whatever Powell's saying. Like the last thing out of Powell's mouth literally was, well, I would have cut rates if it were not for tariffs. We're going to show you what's happening in the tariff front right now. So, I don't know if it's going to happen or not, but here's the bottom line for you as a housing and mortgage professional. The markets are forward looking, right? Powell is done in May. Between now and May, we're going to get anywhere from 2 to 4 rate cuts, depending on the incoming information. So whatever happens, it's probably not even a bad time to let the market know, what's going to happen next. I mean, it's just a wild moment, but that's what the shadow Fed is all about, trying to communicate what's going to happen in the future. And by the way, I'll give you one more nugget here on this change of guard in the Fed. If we do get a new Fed like Kevin Warsh, he said 2 things. One, I have no interest in buying mortgage-backed securities, so that's a negative, right? And by the way, they should be doing that. They shouldn't be buying bonds if the market is stable. But the other thing he said is they want to get rid of the quiet period. So come this Friday, what that means is in advance of every Fed meeting for 12 days, Fed officials don't talk. And what he wants to do is, they want to extend that. They want to get rid of forward guidance. They don't want Fed officials talking at all. And by the way, I'm sure Rob, the folks at every lender across the country would embrace that, because the volatility that we've seen caused by the Fed simply from lack of unity, 12 people saying 12 different things, it's been unnerving. So I think it's going to go away. So there are better days ahead as it relates to the Fed. So this is John Travolta looking for tariff inflation, has not manifested. Right? It's just not there. And what I would argue, again, there's experts, there's, economists and great thinkers at universities, but then there's the boots on the ground, right? It's just kind of street smart. If a person could have charged a higher fee during the last few months, right, because of the fear of tariffs, they would have done it. So it looks like it's getting eaten. This 10% tariff or whatever it's kind of based on, it's going to disappear. We're going to find out. But I looked at CPI this week, and in there, everybody said car prices are going to go higher, thousands of dollars. The headlines were crazy, and auto prices deflated. I mean, they didn't even rise, and they didn't rise more slowly. They actually deflated. There was deflation, which is crazy. So they're getting it wrong, and they're going to have to pivot. Even this gentleman, Austin Goolsbee, who is not exactly, quote unquote, a MAGA, right? This is a Chicago. He was an an economist, and he's saying, hey, if we don't see inflation resulting from these tariff increases, then in my mind, we never left what I was calling the golden path. If the dirt is out of the air, then I think we should proceed. So even he is saying he's trying to hedge that, goodness, we're not seeing tariff inflation. The numbers are the numbers. I mean, inflation is in the twos. The Fed funds rate's in the fours. That's 200 basis points. There's room for the Fed to start cutting. Because remember, a Fed rate cut, it's months before it even hits the economy. So those are coming. But when your guess is as good as ours, right now, the chance of a Fed rate cut in September is a coin toss, 54%. Right? That will be subject to the data. This is why you need to be plugged in with the loan officers at Evergreen. They're going to be dialed into this because the story changes. And what I would encourage both sides of this transaction to watch is let's see and be careful what we wish for as it relates to, rapid cuts, because in the rapid cuts that we had last year, the long end of the bond market didn't like it because it brought in inflation fears. I had a little fun. By the way, if we're not connected on LinkedIn, I put this crazy post at 6:30 this morning when I was having my coffee. I said, hey, let me pull up the lyrics to should I stay or should I go, and add what happens if the Fed Chair Powell gets removed. And so you could see that on there, but let's have some fun with it because otherwise we'll be crying. Now, speaking of crying, there's my old friend John Candy ready to eat the old 96er. This is for the realtors and the mortgage professionals. And it's important because you all have a joint client and they are hearing stuff in the media and they're like looking like the guy just said, you got to eat the grizzle. Remember, he was all scared. The media goes crazy. Remember, it doesn't say, hey, Rob, good morning. Things are great. Come check in next week. That's not how it works. They have to sell fear. Fear sells. So look at the headline on the left. This was from a couple months ago. But U.S. consumer sentiment extends plunge as price expectations soar. I mean, people were probably wanting to set their hair on fire, right? The tariff uncertainty and this and that. Jim Cramer, he made a good call. You should sell your stocks. He told people to sell on the worst day in the history of the stock market. I mean, the stock market since then has done nothing but go straight up. And so here's the point. Surveys, that's called soft data. Soft data are consumer sentiment, like Michigan sentiment, and it's soft data. Soft data is a survey, which is kind of like a poll. We know polls are wildly incorrect. They can be wildly optimistic and wildly negative based on the use case. And so that's the same thing with these consumer sentiment. And so on the price expectations, I just told you that inflation is running in the twos. CPI, core PCE, the ones that we need to follow, they're in the twos. But when you ask consumers just 60 days ago, where do you see prices increasing over the next year? They said 6.5%. Now, I've spoken at several state MBA associations, a couple of broker events, all these different events. And I said, if you got one thing today that's not going to happen, prices are not going to rise by 6.5%. And by the way, since then, they've gone from 6.5 to 5. Before you know it, they're going to be in the twos as well, right? So you have to take these things with a grain of salt. You can't discount them, right? Because we don't want soft data like these crazy fears to become in the numbers, but it's not happening. Okay, inflation. On the inflation side, because this is something that's real important. You can see on the right side of the chart, it's disinflating. It's moving lower. It's way off the highs, and we're at 4-year lows. Now, what's interesting is inflation. 42% of that 2.9% comes from our world: housing, shelter, rent, and believe it or not, the craziest one, and something that we're all going to have to watch together. And you want a little instant street cred as you talk to folks this week. Insurance. Insurance was a monster number this past month as new terms came in. It was like 1.1%. It made up 0.49% of the 2.9. Think about that. Just insurance. So that is something that we hope is maybe a one-off, but it is going in the right way. It is going in the right direction, and we should be excited about that. Now, even the Fed has said, inflation is going to end the year higher. but their own forecast mechanism still, you know, solidly beneath 3%. They want this number at 2%, but it's at 2.6 now, going to be 2.7 at the end of August when it's reported for July. It's going in the right direction. And you could see here, this is the Fed's favored gauge of inflation. This is 2.6%, 2.7% year over year. And you add all these little bars up. You can see the last few months, this is why we're saying, hey, Powell, what are you doing? I mean, we're sub 2%. These numbers, we're running at like, we're running over the last 6 months on an annualized basis lower than, well below the Fed's target. That's why there's, claims, hey, maybe we should start cutting rates. Of all the things I could talk about, and I could spend hours with you, we can dive into a million subjects. If there's one that you take away with you, oil and 30-year mortgage rates. I've been talking about them for decades, and I'm always vindicated. Last year, back in September, 30-year mortgage rates and oil hit 2024 lows like within the same few hours. Now, they don't always work in lockstep, but you could see going over the long haul, they ebb and flow together because oil is like almost like a kind of a number of or an image of as to where the economy is. It's also highly inflationary and disinflationary depending on if it's going higher or lower, and it drives long-term rates. And so you have to watch what oil's doing. And then even in this year, back in the middle of January in 2025, oil hit $81 a barrel. 30-year mortgage rates peaked like above 7, and look what happened. They declined together. So you have to watch oil. And so now you look back, you leave this call, and you're watching what is oil doing. It's in the mid 60s. If it stays mid 60s and goes lower, that's really disinflationary. It's a great story for inflation, which is a great story for long-term rates, and it's a great story for the Fed to say, hey, you know what? We missed it on tariffs. Inflation certainly is coming down, and like Austin Goolby said, we're on the golden path. Let's start cutting. So don't be surprised if more cuts come than what the Fed is saying now, because they always miss it. They're always late, and they're going to be late one more time. Jobs, real quick. And I'm watching the clock, Rob. I'm good. So on the labor front, we have 4.1% and 147,000 jobs. It wasn't a great number. It was okay. And again, another reason why the Fed should cut. The way you get the unemployment rate is you take the size of the pool. How many people are available to work? And we have 170 million people to work. And then you just take the amount of people unemployed, and that's how you get your unemployment rate. But if the amount of people available to work shrinks, that's an artificial way of seeing the unemployment rate go down. That's what happened last month. We had 130,000 people kind of leave the labor pool. Now, there's retirement, but that should be offset by people entering the labor pool. That's a bad data point. So it wasn't all that great, this number, and it's another reason why the Fed should do something. Growth, real quick, on growth, on economic growth in a recession. The punchline here is we had a bad first quarter. It was completely related to tariffs and companies trying to buy product before tariffs because there was a fear they were going to be installed. So before the tariffs were punted, you had to go out and buy goods. And what happens from trade is as a country, if you buy a lot of product and you don't export a lot, you have a trade deficit, and that gets removed from GDP. And that's why we had a really bad number. But that's a one-off, and we're not happening again. So, real quick, I'm going to move through this because that's not important. This is interesting. There's some old folks on this call, Rob. Remember Name That Tune? Well, name this unsustainable trend. And the one where I want to grab you is when it goes from the 2010s to the 2020s. There's an old saying that a guy said in politics, never let a crisis go to waste, right? And so when you go from the 23s to the 27s, what that number is the level of federal spending in relation to GDP. So it jumped, and it jumped high. So when you're hearing Congress, we want to get back to pre-pandemic levels, that's exactly the number. They have to stop that egregious level of spending. It's way too much, and that's what we have to get back to. And you could see what happened over the course of time. Like back in, Clinton was president, and they got to a balanced budget. You could see they went from 22, they actually retreated it. So they shrunk the government. So this isn't like the efforts that we're trying to do today is not foreign, and it has to happen because debt is a big problem around the globe. There is no chance of a recession, but we're not out of the woods yet. And I want to push forward a little bit on housing and interest rates. So here's, on the housing side, we know our problems, and your problems are very similar. We're both on the coasts, high prices, higher rates, higher insurance premium, higher building costs. I think building costs I read are about 25% higher than they were just right before the pandemic. And then we have this low housing supply. The fix, I mean, nothing fixes this more than just a stable 6% mortgage rate. Like you're saying, where do we need mortgage rates? We don't need mortgage rates in the fives. That movie's gone. Right now, I think people have come to the realization that the twos and the threes that we had during the pandemic, those aren't coming back anytime soon unless the crap really hits the fan. So at the same time, though, we should not expect a 5% rate just yet, but a stable six will allow your joint clients to wake up and say, hey, things are kind of calm. The tariff noise is there, the economy's growing, we're doing things. I mean, that's a good story. And then the other part, sadly, and this is where, we know federal government and Congress can be inept, but at the local level is where we drive a lot of change as it relates to building housing supply. And so whatever efforts that you folks on the call can do to help with that, that's a big, big thing. There's no quick and easy fix. As we know, I mean, we're 4.3 million homes short right now. But the good news is there's going to be a continued tailwind. I think the biggest thing that happens over the next several months together is if we see the economic growth that we'd all like to hope for, and the bond market stabilizes, which I think would work in unison, rates come down modestly. By the way, spreads come down in between mortgages and 10-year note, right? There's a bunch of good things that happen, and things do get better. So this was last year's my hazards for the golf for my golf thing. If you want to avoid a big bunker, and it's funny, out of those four, debt, oil, election, and global uncertainty, boy, they were all accurate. Remember dodgeball, right? The 5 Ds: dodge, duck, dip, dive, and dodge. Well, it's debt, fiscal policy, and debt. I can't talk more about it because the debt isn't just our problem. It's around the globe. Germany has their own version of a big, beautiful bill. Japan is trying to normalize rates. Japan yesterday, their 30-year government bond, their debt hit the highest level this century. It hasn't been this level since 1999. So as those rates go higher around the globe, it puts pressure on our rates. So you can't just go like for the folks at Evergreen, it isn't just inflation. It's not just, debt, our debt. It's what is happening around the globe because the bond market is global. And then let's talk about rates. And so this is what folks at Evergreen look at my product as well as some real estate folks. These are mortgage-backed security prices. And what I built here is like a channel. And as prices go higher, rates go lower, that inverse relationship. And as prices go lower, rates go higher. And you can see we're in a very clean channel, and it's about 175 basis points. So for everybody on this call, that equates anywhere from a quarter to 3/8 in interest rate. So one takeaway is there are better times to lock and float, right? You can't, like back here, we were telling our subscribers, hey, this is a market trying to find a bottom. You should try to float some right here. And if you did, this was one heck of a rally. We went up 175 basis points in just a couple of weeks. And then look where it ended, right? A couple of weeks ago, I'm sure there are people around that were like, hey, float, Kelsey, call me next week. Meanwhile, the train was pulling away from the station and there weren't a lot of clients on it. So now we're right in the middle of this range. So the punchline here is if you have the ability to track this with your mortgage professional, I would be telling my sister about interest rates. We're stuck in this range. And it's kind of like, if you look at where the economy is, there's uncertainty around tariffs, there's uncertainty around fiscal policy, there's uncertainty around debt. There's no shortage of uncertainty, right? Nothing happens until we break above this. But what I can tell you, I'd say, Mom, if we break above this, rates are going lower and there will be no stopping it because this is like my Philadelphia Eagles. I know we have the Seahawks up your way, kind of forming that offensive line, holding prices or holding players from going back. If bonds can push through that ceiling now becomes a floor. And so the best rates that we saw a week ago, right, or 2 weeks ago, those could represent about as bad as rates can get, right? So that's a really big thing for all of us to take away. And then the other thing for the realtors on the call who are out there talking to consumers and borrowers, here's your nugget because you don't have access to mortgage-backed securities. You want to talk about the 10-year note. It's not going to run in lockstep with mortgage pricing, but it ebbs and flows. A couple of big takeaways. Number one, we have now approached that area where I say the cure for higher rates is higher rates. What do I mean? You can see this chart goes back 3 years. Every time the 10-year note is traded between 4.5% and 5%, yields decline, and they declined in a hurry. Why? It's like all of a sudden rates get to a level and investors start sniffing and say, wow, US yields look pretty good, 4.75. I'll buy it. Then Rob buys it. Then Kelsey buys it. And then Tika buys it. And all of a sudden you have a nice, beautiful rally and yields decline. Let's hope that movie continues. Now, the level for the realtors that I would watch, we're in a clean, it is clean as day between 420, 4.20 on a 10-year note, and 450. 420 is a floor of yield support. What does that mean? It is stopping yields from getting better, and it's been a bear. Here's what I can tell you. If we push below 420, 420 goes from a floor, which is now representing about as good as rates can get, to then a ceiling, and it becomes about as bad as rates can get. And then what you're going to see, friends, is the 10-year note move from 420 and then down to 4%. And then once you get below 4%, then 4% hopefully becomes a ceiling about as bad as rates can get. And that equates to an interest rate somewhere in the low to 6% and in a stable spot. That's the movie that we see coming. Is it can happen tomorrow? I doubt it. No one knows, but that movie's coming. And why? I'll leave you with two more really wonderful tailwinds that most folks do not know about, and I think it's great for anybody to be sharing. So I said the Fed's not buying bonds, right? Then when you guys were all killing it, you couldn't breathe, refinances were going crazy, interest rates were 3%. The Fed was buying bonds and putting on the books. That's over. So you have to ask who's going to buy the bonds. We need someone buying, and we need buying demand because we have to keep selling debt because we have too big of a deficit. Well, there's this thing called ESLR. Copy it, write it down, Google it later, and take a look at it. ESLR is the Enhanced Supplement Leverage Ratio. Big technical term, but here's the punchline. The Fed is going to lift regulations on the 8 largest banks on the planet, who together control about $12 trillion, just a few bucks. And it's going to allow them to buy treasuries. And when they do that, and it's going to happen, it's going to put a buyer in the market. And so for those that are betting on higher rates, it's like me going to the ocean when I'm done with this call and they say there's a shark in the water. I'm like, well, okay, I'll sit on the shore. Meaning, if there's somebody that if there's a pressure that prices can go, higher and rates can go lower, I'm not betting on higher rates. I'm going to stay out of that. I'm going to stay out of the water if those big banks start buying bonds. So it's a really good story for us. And then the second one, and this will be the last point, Rob, because I know I'm getting there. On July 30th, I encourage all of you to mark that day. It could be one of the wild days in the bond market. Why? And unless we get some news bleeding into it, July 30th, we're going to have a Fed meeting. We know nothing's going to happen, but we have no idea what's said on the statement. We have no idea if they say something about regulations. So that one we're going to pay attention to. But what's going to be crazy that day is that's the day that the Treasury makes their quarterly refunding announcement, QRA. And there's speculation that Scott Bessent is going to announce that they're going to issue little to no long-term debt. And another takeaway, I love my sayings, bonds hates more bonds, and the opposite is true. If the Treasury does not issue more long-term debt, that makes the existing 10-year notes and 30-year bonds more valuable. And it also doesn't have them freak out at auctions. It stabilizes rates, maybe even helps narrow spreads. It's a really good story. So we're gonna have to watch July 30th together very carefully as we go through the rest of the summer. So I want to pause there for a minute because I hit the folks with a ton and would love to take some questions. Let's see. I'm gonna looks like there's some here. Here we go. Okay. Hard to hear. Okay, hopefully I figured that out. Please. Let's see.
I have a question here from Cole. Did you address that one?
No.
Cole, it says, Bill, if we are 75 to 90 BPS off to get to the stable rate, plus or minus, what is the likelihood we can reach that target in the next 8 to 12 months? Will it likely hinge on the economic news at the end of the month?
So I guess Cole, you can type in there if you're talking about what like a neutral rate is. There's a saying of what like a neutral Fed funds rate is, and that's a Fed funds rate that neither helps or hurts the economy, and that's estimated to be anywhere from 75 to just over 100 basis points below current levels. Case in point, the reason why the Fed should cut. That is probably not going to get achieved quickly if Powell remains Fed chair, and he is going to remain Fed chair. I don't think he's going to get fired, and he shouldn't get fired. I think I should just leave it alone. I think we should focus on the 10-year note and just allow this to play itself out. So I think that it happens, and it will happen by May, and if not, it'll happen very quickly thereafter. But May is a long time away. There'll be a lot of data. I mean, frankly, Cole, we're one bad jobs report from everything changing because there's just Powell has said, many have said, any further cooling in the labor market would be unwelcome. So we don't want, as I shared earlier, we don't want to have unemployment uptick for lower rates, right? We don't want that. We can't have that trade-off. Do you have any suggestions addressing buyer skepticism when media headlines are talking about rate relief, but rates still feel high? Yeah, Kelsey. So, rates are obviously relative, and that date the rate thing. We've heard that buy the home, date the rate. I think for some people, looking back, may not have helped everybody. We're at the tail end, in my opinion, of the higher rates. Are rates going to get much better? No, but I don't see them getting much higher either. And when they do come down, and we get a flurry every time, if I were talking to my sister and she was thinking about buying a home, opportunity doesn't come screaming, right? You got to take advantage of it. And if you wait for everybody to see that rates have stabilized, now the negotiations are really different in housing. It may feel different, but when you look at the way incomes have risen and stuff like that, they're not that high, and you got to kind of walk them through it, right? But the idea that you're getting 4%, that's not happening unless we have just an absolute calamity. So I would get people real comfortable, because if you look back 50 years, we're probably right in the sweet spot. We're probably lower than the average interest rate in the last 50 years. So I think that it is all relative. Rob, why don't you answer that? We have an agent asking the buy downs. That's an evergreen question. I'd love for that.
I was going to go back to a suggestion on the last question, and that is if you go back to any of the buyers that bought in the last 2 years and ask for a copy of their appraisal or closing statement on what they bought their home for, and then ask for what the value is today, and show them the appreciation between the closing statement 2 years ago and today, and say that's not real. Our job is to create generational wealth. And homeownership is the first entry to building somebody's generational wealth. And without the younger generation investing today, we won't have a buy-up market later. So true facts solve that equation by just taking deals that you have in your rearview mirror and bringing them back to the table is a great answer. I'll have one of my good loan officers step up. How about Brett? You want to answer your buy down question? Brett, are you on the call?
Yep, sure. So I think the question was how would you advise somebody considering a buy down in the current market? I think kind of to tail end what Bill had said, if we're hopefully at the tail end of the high rate environment, but again, rates being relative, we're still high to a younger buyer, that a potential temporary buy down would kind of help with that payment relief in the short term while we're on the tail end of this rate trend. So
yeah.
If the rates are higher today, obviously with that temporary buy down, it helps them with that lower payment for depending on what type of temporary we're looking at.
And wouldn't we also suggest don't drop the price of the home? Use that money that you would use to drop the actual price to give an incentive back to the buyer so that they can use that towards the buy down and get the relief instantaneously versus dropping the price.
Love that.
Okay, any other questions? Anything else in the chat?
I'll just pop out there and say I've been listening to Bill for, I don't know, 10, 12 years. How long have you been doing this? I missed the start. I had some things to take care of out here, but
20, almost 25 years, 24 and change.
when
it's been a
did you
minute.
start with it? So and I'm sorry if I'm making them repeat all this, everybody, but it was Mortgage Market Guide, and then it became Terra Brasa, but there was something else in between. Yeah, so no, I've been every morning. That's the first thing I look at for the last. I can't even tell you how long. So I appreciate you. I
Fantastic.
appreciate you doing this, and yeah, just want to
Appreciate you,
throw a
my
shout
friend.
out there for you because I like yours. I like yours better than because somebody else in my office uses Barry Habib or whatever.
Who is
Yeah,
that guy?
well, you don't have to worry. He looks the same because he dyes his hair blacker and blacker every single day. Yeah. But anyway, thank you.
Thank you, Kevin. Appreciate you, my friend. What other questions?
I see one that came in. It's
Yeah.
from Lawton. His question is, why did rates increase with the September Fed rate cut?
Yeah, last year? Okay, so, first off, it was an unusual rate cut. It was weird. And here's what I mean by that. We hadn't seen the Fed tries to stay apolitical, and they do not try to cut. They try not to take any action in between the political conventions and the actual election day. That was the first time it happened in decades. And to come out with a 50 basis point banger, that was like, wow, what just happened? And so the bond market is seeing, well, crap, if you're going to do this, this is going to be inflationary. And so it seems kind of counterintuitive. One of the reasons why rates aren't going higher, long-term rates, is because the Fed is sticking around to fight inflation. So, I would almost argue this is why, by the way, great question, because this is why in the last 24 hours we watched the 30-year bond spike. As soon as there was a rumor out there that said Trump is going to fire Powell, and long-term yields went higher because they said, well, crap, if they do that, a new Fed's going to come in and lower rates, and that's going to stoke inflation. And then the minute he stripped it out, stocks went higher and interest rates calmed down. So, it's got to be slow and steady. It's all about inflation and all about the debt. But that's a great question. And it seems counterintuitive. And this is case in point. Fed rate cuts have no impact on 30-year mortgages unless it's aggressive one way or another. And back then it was aggressive.
Bill, you can share, obviously, before rate cuts happen, typically the market is priced in ahead of the actual rate cut. So I know that we talked earlier this week about how the markets already are hedging ahead of 5 months ahead of now when
Yeah.
Jerome Powell's term actually ends. So the market's already thinking about that today. Just like in the past, the markets had hedged in way before the rate cuts. So we were seeing the relief and giving the interest rates to the borrowers before that 50 basis points hit. So a lot of times people are sitting there and the news announces, hey, rates dropped, and the consumer thinks, oh my gosh, my mortgage rate that I'm going to lock is going to get better. But we've already given it to them a month before or 3 weeks before. Can you explain that real quick?
Uh, I didn't follow what the question was though, Rob. Like,
Well, everybody's asking here about the rate cut of 50 basis points and
yeah.
the consumer feel it, et cetera. A lot of times by the time it hits the Fed announcement and you see it on the news, the rates have already been adjusted downward. We've already hedged
Oh,
for it way ahead of time.
yeah. I mean, I think that there's two things. That's exactly right. Like, so the bond market is pricing things in. Like you're already seeing here. See the 2-year note? This is my mortgage market guide product. So, to your point, Rob, the 2-year note's at 391. That is the 2-year note tries to kind of front run the Fed. So it's about one cut ahead. It's seeing like one cut over the next like quarter. Now, if we get a bad jobs report, that 2-year note is going to drop like a rock before the Fed does anything. It's going to basically say, if Rob were the Fed official, hey, Rob, it's time to pull the trigger. Like if this goes to 375, that's like the bond market saying, hey, guys, you really got to cut rates. But at 390, it's saying, hey, you're probably okay here because we're waiting for the data. And this is why for the realtors to be plugged in, with educated loan officers like yours, this stuff is going to change. And when it changes, it's going to move fast. And I just showed you the breakout levels. So when you're looking at the data and then you get the breakout levels, you know exactly what to tell your clients. It's crystal clear. It's like connecting the dots.
Perfect.
I did get kind of a similar question, so maybe you could add color to it. How much influence does the Federal Reserve actually have over mortgage rate? I know you mentioned nothing. And what should we listen for in their announcements that we need to watch out for?
Oh, great question. So yeah, so there is no direct impact on mortgage rates. What we should be watching all is like there's a thing called like a credibility of the Fed. And when they're talking about fighting inflation, like virtually every um speech, press conference, he prefaces with, "We're here. We know there's hardship, and we're here to fight inflation," because it's a killer, right? And inflation kills the lower part of the income scale, the worst. And so what we don't want to hear is that like we missed it, right? Like back in 22, when he said inflation's not transitory, the bond market looked at each other and said, "Are you freaking kidding me?" I mean, like that was when he said we have to retire that word, we got to stop buying bonds. I mean, we went from 3-year 30, 3% mortgage rates to 6 pretty darn fast because the bond market just had a hissy fit. It was like, what are you guys doing? You have all these billions of dollars. You're telling us it's transitory. You're telling us it's transitory, and now it's not. So I would be watching for that type of language because they lost a lot of credibility then. And we have to be, and by the way, they're kind of losing it a little bit now. They're hiding behind tariffs and this and that. Inflation has been moving lower and they're saying it's going to perk up, but it's just not in the cards. So I look at more than what they say about inflation and I would watch the price action. Another level to take with you is 4.50. If the 10-year note goes above 4.5%, it will get dragged higher and mortgage rates are going with it. There is a lot of resistance. The bond market is fighting to stay beneath 4.5%. So take that with you. I listen to what they say, and then I immediately look and see what's the bond market think of it. Because guess what? Out of all of us on this call, the bond market's the smartest person in the room.
You got a really loud one on the questions down below, Bill.
Okay, let me see. The Fed is supposed to be apolitical. Why does it appear Powell is playing political games? It appears that Powell is making it a personal issue and he's not looking out for people. Well, Brian, I will tell you that I hate to think that it's being political, especially when it first happened. Like we've been calling for lower rates for months, but now we have the benefit of hindsight and data. And good grief, I mean, CPI came in lower every month. That means the Fed's favorite gauge at the end of the month is going to be lower, right? Because the CPI comes in first, and then a couple weeks later, we're going to get PCE, and that's going to be low. So it's like, good grief, what are you doing? And the problem that he's done is he's holed himself in the corner saying it's tariffs and tariffs. And even his own people are saying, Jay, it ain't happening. There is no tariff inflation right now. And by the way, back in the day, 30 years ago, I'm old enough to remember they'd say, well, crap, we're going to cut rates. And if the inflation comes back, we're going to hike. And by the way, we're not going to tell you. We're just going to do it. We dealt with it. There was none of this forward guidance crap. People hiked and cut rates and the market dealt with it. He's acting like he's, on some, pulpit kind of, preaching. And it's like, I think he's going to be wrong again. And they're always late. If I showed you a chart of the Fed funds rate and recessions, every time over the last 40 years, they're cutting into the recession. So let's hope he doesn't put us in one because the economy, I talked about the resilience of the housing market and the economy. It's remarkable how consumers and the housing has remained so strong. Can you imagine just a little bit of downtick? You can't play with it forever because at some point something breaks and then, the crap hits the fan and we have a problem. And that's what the worry is. Like you're testing the limits because at some point something snaps and then we have a problem. And then rates come down for the wrong reason because, it's hitting the fan.
Robert, can I ask Bill one question before I have to drop off early?
Hey, Cole.
I know
It's
there's
all
a bunch
about you
of
today,
questions.
Cole?
Well, there's great questions in there from Walter and Dylan, so I don't want to step on their toes, but I do
Yeah.
run. Bill, one of the things that I tell my clients and my agents is there's never really a perfect time to buy. You buy when it's the right home in the right budget with the right plan post closing. So setting somebody up for success. But buyer trepidation is based off of rate, payment. People have alluded to temporary buy downs, which I think are more band-aid fixes, more than permanent solutions. But
Right.
home prices are still a concern. So is there any data metrics that you have or that you're seeing that give you some sort of blueprint outside of just the basics of supply and demand of where are home prices going in relation to rates in these new established floors and ceilings, which only have about 100 basis points spread in the next 12 to 14 months? So I guess it's more of a comment, but more on how do these data points intersect with what we're potentially going to see home value wise nationally over the next, call it 12 months or something?
Great question. It wouldn't surprise me to see further flattening in home prices. Like when you have, resistance, and builders have to pull out all these, measures to get folks in the homes, it means we're getting to the end. Like there's only so many, as you said, like buy downs. There's only so many things you can do to where at some point prices could maybe even outright retreat. Now I know where you folks are. You've had some really incredible price appreciation, like we've had in New Jersey. Some of it is way beyond normal. Like during the pandemic, growing at 25% a year. I mean, that's a big gain, and that has to get kind of absorbed. It's almost like a big meal, and like it's going to take years to kind of that's like 10 years, multiple years of appreciation over the course of 2 years. And so it's not surprising to see things flatten out. And we're seeing coal, some areas of the country have outright price declines, especially the previously hot ones. So don't be surprised if we have some of it. And what would change that? Certainly it sounds counterintuitive, but a little bit of interest rate would help because it would allow people to move because they can go somewhere, right? That would free up some stock and people will just feel better. And the other thing is builders will go. I mean, I think part of the problems with the builders, they built a bunch and it's like, oh man, rates are a little high, people are a little skittish, and now they're doing price, they're doing things to move homes. We want the builders to be cooking, and I think that we need lower rates for that as well. Right? We need lower inflation and lower rates for so there's no easy solutions. It's almost the same slog. There isn't like something's going to happen in the next 6 months. But what I do like is this, the kind of animal spirits being revived through some growth policy and focus now on the builders. I haven't heard anything out of Pulte other than let's just shoot Jerome Powell. What are we going to do to help lower the cost to manufacture a home and maybe even a loan? They should work on that too. Like how do we do that? That would be, I think, what the housing and mortgage industry wants to hear.
Thank you.
You bet. What key features would have to happen for 30-year rates to drop into the mid fives? You alluded to this earlier. Yeah, Dylan, how you doing, my friend? I think the labor market's the big one, right? Inflation's going in the right direction. Inflation, you do the numbers. When inflation is at 2.9% and 42% of it's housing, and I just shared with Cole that we see price declines and rate declines, we could be sitting around all of a sudden 6 months from now and inflation's below the Fed's target, and they're going to be cutting like crazy. Remember, around the globe, Europe has cut 8 times. I mean, there's a lot of cutting. Like we're in our own little world with these elevated interest rates. So I think it's a labor market. If the labor market has a real, dog print, right, lays an egg in one of these upcoming months, that changes everything. That changes everything. But the other thing that I think that the bond market would love that we don't talk enough about and the media will not touch it is how we handle our debt. Like that July 30th, if we talk about how we can do something with debt and we can get folks to, the stable coin. I heard something on stable coin even. Like it was crazy about upwards demand of treasuries for buying like cryptocurrency. So there's a lot of crazy things, but I think, Dylan, at the end of the day, it's the labor market. It's the health of the labor market. If it weakens, it helps the bond. It would help the bond market in an outsized way. Yeah. What else there? It's a good
And
question, Dylan.
there's one more from Walter.
Yeah, Walter. Do you feel the value of homes increasing so high when the rates were in the twos, the cost of HOI and increasing cost of build more the impact? So let me read that out loud for everybody. Do we feel the values of homes increasing so high when the rates were in the twos and threes, the cost of HOI and the increasing cost to build more of an impact of people sitting on the fence than the rate adjustments? Well, like I said, those couple of years that we had during the pandemic with low rates, it's a perfect example of when you have too much money chasing too few goods. That's the definition of inflation. We lived through it. It was stark. And so here we are now, years later, trying to work off of it. And what I just shared with you is that still within the inflation number, the biggest component is housing. It's 42% of that 2.9. Can you imagine if we have almost no price appreciation in homes? It flattens out further. There will be no inflation. They'll be looking for it, like that John Travolta slide.
I also think, Bill, that we have the nation sitting on this call today, and every market is a little different, right? Depending on where you're at in Florida, where they were getting 200,000 people a year moving into the marketplace, and last year they had 64,000, so the builders built for 200,000. You have more inventory, so it affects your supply and demand, and you're oversaturated in the housing. So Walter's in Texas, his impact is a little different than sitting in New Jersey. So every market in America is different. I know we're getting towards the end here. I just want to say that, first of all, it really pays to invest in yourself and show up to calls like this and becoming a subject matter expert. I know you're going to share a link to becoming an economist. I think that we all need to lock arms as all working together to provide the dream of homeownership in our markets and provide generational wealth to our clients. I know it takes more than just one person to get this done. So it's so important for our business referral partners, our mortgage professionals, et cetera, to work together. You know, consumers will pay for knowledge, wisdom, and expertise. And that's what we need to work together to provide for the dream of homeownership, because there's a million ways we can get somebody in the house. And to provide affordability, we give people those tools. And that's why we need to talk more, have more webinars like this, and work together and lock arms and bring those to the market. So is there any other questions? Because I know we're getting short in time. Oh, that's the link to becoming, okay, an instant economist.
So share that with everybody after, but at least it's in the chat if anyone wants to click it and get it in their browser. Thank you.
Okay. Well, I think we're rounding up the hour here. I just would like to, first of all, thanking everybody for their time today. We so appreciate the partnerships of our referral partners on the call. We could not be in this business without all of you. We appreciate your business. We appreciate your partnerships. And we're here to help in any way we can. Bill, we so appreciate your knowledge and wisdom and pouring it into us so we can also become the subject matter experts. We're in a battle. We're against the fear in the market, the media display of information, but we have the tools and we have the knowledge and wisdom, and we have one big thing, and that's called mindset, and we can help people buy homes. So thank you all. Thanks for taking the time with us. And thank you from Evergreen Home Loans to you. We appreciate it. Have a great day, everyone.
Take care. Thank you, everybody.
Thanks.
Bye now.